Thank you, David, for the introduction, and good morning, everyone. I barely feel like I need a speaker in a room like this, but hopefully you can all hear me. It's a pleasure and a privilege to actually be here today to speak with you, and I appreciate the FTA inviting me to come along and talk to you about the topic of the domestic corporate bond market. It's also great to see some friends in the audience, and look forward to any questions you may pose later. I think today there's a tremendous array of speakers to speak about a variety of markets, from offshore, domestically, loans and so forth. And I think I'll sort of start my discussion with my topic today is the domestic corporate bond market, but the truth is there's no one shoe that fits all. In fact, many of the issues that we're dealing with, the NAB are actually accessing multiple markets. So when I talk about the domestic corporate bond market in itself, and I believe it's the panacea for everyone, but it's definitely becoming a key part of a lot of your funding plans for Australian corporates. So on that note, I'll start my thesis, I suppose, by saying that Australian corporates have been continuing to diversify their funding now really since the GFC. That's been a key takeaway. And what they've actually been doing is that the funding diversification, I'll alert you to this pie chart, has sort of changed. So picture yourself back in 2009 where we actually, there wasn't that many capital markets open. The key capital markets in the bond space that were open to Australian corporates at least was really predominantly the 144A market. So we were seeing activity in the 144A, which is sort of consider like a public market in the States. The European markets were open, the USPP market was definitely open, and the MTN market has just started to see some early signs of activity. Wasn't a lot of issuance though at that stage. In fact, the only thing really happening around 2009 was typically 3-year bank loans, and you can all think about those. So you fast forward 5 years, and the pie chart looks different. Now, these numbers can be thrown around by big transactions, and I've purposefully excluded the $5 billion deal from BHP because it distorts the underlying trend. What we've seen is we've actually seen a renaissance of the domestic space. We've seen a bit of a fall away in the 144A. We've seen the euro market still remain very popular, and the USPP still remain highly relevant. So the pie looks different, and we think this is not a one-off trend. This is which I'll speak to in a moment. So you can see the sort of volumes that the Australian corporates in 2013 raised in capital markets. And it's pleasing for me, having been in this market for many years, to see the domestic market actually be the largest corporate bond market that Australian corporates have actually used. So I guess I'd point out this is not necessarily a one-off point. This is really part of an ongoing trend. So if you look at the compound average growth rate and the use of capital markets from Australian corporates, it's just under 10%. What's actually clearly happened is, and I'll just point out, explain, if you go to 2012, I mentioned those 3-year bank loans, they all were getting refinanced, typically around about 2012, and there was a lot of wrapped bonds or financial guarantor guaranteed bonds that were getting refinanced, particularly around the utility space at that particular point of time. So even though the volumes have come off in terms of capital market activity, the trend really is that there's been about a 35% compound average growth rate in the use of the capital market. You can see Europe still very healthy. Anything in double digits is very healthy, frankly, 20%. And really, as you'll hear later, the euro markets are one of the hot topics in capital markets for this year. And there's some in this room have actually accessed those markets in the past 12 months. The USPP market still retaining that high level of validity, and put our 144As in the negative, but I wouldn't necessarily point any fingers at that. That's just a function of the fact that there's far more opportunities to diversify. And in fact, one of the trends you'll hear later is that the European market is just as price competitive as the US market at the moment. So on the topic of the domestic corporate bond market, let's talk a lot of stuff on this slide. So but we'll start with sort of what's the total volumes that we see in the overall market. Well, it's 98 billion in 2013 across financial supranationals, and in general for the last 5 or 7 or so years, around 100 billion of issuance. However, the corporate portion of this is actually quite low. So the Australian corporate bond market, frankly, is very small. and it's certainly small relative to offshore capital markets. So the USPP market, for example, has about 50 billion of supply in it. The Australian, so it gives you a context of the Australian corporate bond market at 12. So in a proportion of the pie, the Australian corporate bond market is really quite small relative to the overall issuance. Hence, you might see 3 or 4 or 5 financial issues get done every week, and maybe there might be one every week, one every couple of weeks. It just depends. There's probably about, as you can see out there, 49 transactions last year, so still reasonably healthy, but nothing like the 276 financials that you can see. The longest transactions we've seen have been out to 10 years, clearly not the sweet spot of the market, but the trend which I'll speak to shortly is this extension in tenor, which is something very attractive to corporates because the banks generally aren't lending beyond 5 years. In fact, they're only just sort of starting to get back to 5 years. Smallest deal you can see is 30 million. That's in reality private placements. A deal in the Australian market is typically a minimum of $100 million, and it's $100 million to be in a corporate bond index. So we launched a transaction yesterday for Perth Airport with a minimum of $150 million, and I'll speak to you shortly. There'll be a far bigger transaction when it's concluded, however. So you can see the largest transactions have been, so this was Horizon, $13 billion is BHP. It's clearly of an outlier in many respects, and prior to that was Westfield. But we often see transactions in that sort of 250 to 400 million type mark, and it's not that that's the size of the market, it's just that there's only so much that Australian corporates ever want in one maturity. They often cap it. So if you're a Wesfarmers or Woolworths, you can have 500 million and you're very happy with that. A lot of corporates, particularly say in property, they only have 300, 400 million maturing in 1 year. So they limit the relative size of the deals. The really interesting thing for me and for the market really this year has been the tenor extension, and I'll elaborate on that shortly, but 7 years was really the sweet spot and is the sweet spot for the market. 40% of supply, that's a phenomenal number relative to prior years. Again, I'll come back to it. We've also seen the rise of triple Bs, which I'll also come to, but the market has traditionally been a market very much about A-band, and that's been because the corporate bond investors have been very focused around safety and not necessarily taking genuine credit risk. Interesting thing, every day we read about infrastructure in the papers. Infrastructure went from 0 to 25% of the market last year, and the pleasing thing on the diversity cog there is that the market is highly diversified. A few years ago we saw half the market be property issuance, other years we saw half the market being utility issuance, but now by virtue of there being even a rash of new issuers come into the market, 16 new issuers that came into the domestic market last year, some from offshore, some locally obviously. We're seeing a far greater diversity, and that's great because that means that fund managers don't get full on one sector. So it's a very encouraging trend. So some of the key trends that we are seeing that we'll elaborate on the prior slide that really sets the scene for 2014 and beyond is the growth in offshore demand. So we often talk about the Australian corporate bond market as if there's a sort of perimeter around the country. The reality is this market is becoming very regional. So we are seeing far more offshore interest in the Australian economy. You're seeing that through trade flows. You're also seeing it through the popularity of investors wanting to hold more Aussie dollars as one of the most traded currencies. Nevertheless, the attractiveness of the Australian corporate set means that we're now starting to see more investors. And these are a couple of random examples, frankly. I could have picked any one of a dozen or more. But the point really is that in the transaction that we worked on for Telstra late last year, call it close to 40% of the final order book came out of Asia. Lend-Lease at the other sort of end of the rating scale, BBB minus, with a very a strong Asian presence, but a quarter of the order book out of Asia, 10% out of Europe. What we are really starting to see as a consequence of this, the significance of this is that larger transactions are actually now doable. And when you have a larger order book, it means that you can actually not only sometimes open up a second or third tranche, it also means that you, as an originator and executor, we can actually also ratchet down the pricing ultimately on the final transaction. So it works for a whole lot of reasons, but it's fair to say that issuers are very proactively fostering this interest, and we are proactively taking issuers up into Asia, up into Hong Kong, Singapore, Malaysia and so forth, and Japan to meet new investors. So it's an exciting trend. The one I just touched on briefly was the 7-year piece. If you look at the panel in 2013, you see 7 years and beyond is 47% of the market. So half the market is beyond 7 years. You compare that to prior years, 24% and 15%. It's an exciting trend, and I'll explain why in a moment. And it's exciting because the 5-year market traditionally has been the sweet spot of the market, 5 to 6 year, 56% in those previous years. And why it gets me excited at 7 years is because every time the banks come back aggressively, they come back aggressively at 5 years. And that's where the bond market's been. And so in the end, the banks always ultimately win the day. So when investors actually move out to 7 year, that's generally where banks can't touch them. So in terms of longevity of this particular trend, it's very exciting. Now, why are investors going out that far? Well, you only have to check your swap rates, which we price off swap rates. We don't generally use Commonwealth government curves. We price off swap curves. So swap curves are the base, basically the building block, and you add the credit spread and get the yield and so forth. Yields are very low. Yields are very low to where they are. Look at your mortgages. Rates are very, very low. So investors actually recognise this trend, and therefore they want to move out the curve. They not only want to move out the curve where they can pick up a bit of higher yield, they want to move down the curve. So, for example, I did a transaction last year for Westheimer's, A-. They would do a 7-year transaction. The coupon was 4.75%. And the investor said, it's a great credit story, but you know, it's just not paying me very much. 4.75% for 7 years. So can you bring me something into the triple B band? And in fact, that's really been the trend. As you see, the triple B issuance at just over a third of the market versus it's always been very patchy. You know, sometimes it's been 5 to 10% of the market. So to see triple B be about a third of the market is very, very encouraging. And investors are going there for the yield. They're getting there because they're becoming a bit more mature and sophisticated. And that's really actually opened us up now to a lot of Australian corporates, given that in general the median rating for corporate Australia is probably somewhere around the triple B, or maybe it's heading towards single B grade. But for the time being, in my little world of investment grade, triple B land is where most corporates actually generally are. So a very encouraging trend there. And perhaps the last point here is credit spreads. So clearly we've seen a contraction of credit spreads over a number of years. We all know that. We saw a spike up in the middle of last year around the time of tapering. Credit spreads have contracted. They've probably gone a bit sideways for financials. They've probably ratcheted in a little bit for corporates. So a number of these key trends are all sort of setting the same sort of trends are rolling into 2014, which we think is exciting. So I guess just we talk about markets without necessarily saying, well, who are we talking about? So I've just put a little bit of a slide here around this. Again, this is a very random list of names who have actually accessed the market. You can see them yourself. There's a variety of there's property companies, there's utilities. I mentioned some of the offshore names as BP have come to the market, Connect East. They're all names that need no introduction to you, I'm sure. Not necessarily listed names as well, I should say. And then we don't often talk about the investors. We talk about them like some sort of black hole. But clearly, the large investors in the country, the AMPs, the UBS Asset Managements, Aberdeen's, Tyndalls, QICs, I mean, these are all sort of names you often might associate with the equity market. They might be equity holders in your company. But in fact, they all have fixed income divisions, and they're all actually investing our superannuation money and managed funds on our behalfs. And they are investing in corporate credit to pick up the higher yield. So I thought this might be useful just to help you understand, sort of that, without giving you a complicated table, just to understand the breadth of names that are coming to the market, domestic and offshore. So I wanted to just put a slide here. It's just meant to be very high level, as it is for this sort of forum. Well, okay, what do I have to actually do to access the market? And I know there's a number of people in here who could tell me more about doing it than I can. But if you just had to explain to you high level, what is it that you have to do? Well, in the corporate bond market, let's just start with the assumption that you have a rating. In the Australian market, you have typically one rating. Some have two. It doesn't necessarily garner you any additional interest, in my opinion. In the domestic, some have two ratings to access offshore markets. But suffice to say, one rating from the major rating agencies, like you have the adverts. Typically, what you would do is you would mandate your banks. Most of the transactions probably have a couple of banks. Some of them have the sole leads, but often they have typically two in the domestic market, which is a bit of a contrast to the offshore. Sometimes you might see 3 or 4, but 2 is more the norm here. You actually mandate your banks. You go through a documentation process, which I'll touch on shortly. Once you've actually set that up, it's all very boilerplate. You actually then go through your investor meetings. It's typically a tour. It's typically been sort of Melbourne, Sydney, but I mentioned about Asia. Increasingly, depending on how much you want to raise and who you are, what you want to really achieve, then we're increasingly starting to add on Asia to this roadshow. So it might become what was a sort of 2-day roadshow, may become 4 days. It just again depends on your goals. And these are so typically one-on-one meetings. A pitch book. You open up the pitch book. You're not getting up on forums like this typically. And typically it's one-on-ones and a lunch and so forth for morning tea. Once you've actually gone to those, you've had the meetings, you already go through a book build execution process. So we go back to the key investors. We say, what did you think? Did you like the story? This is what they're looking to achieve. And this is the type of interest. Now, we don't typically go back to everyone. Obviously, we don't want to read about our deals in the financial review. So we typically go back to a small, select list of cornerstone investors who we think might be interested in actually giving us some validation around our order book, and actually from that starting to build a soft order book, and then be in a position to actually launch a transaction. I mentioned the documentation. I'd say it's pretty much uniformly accepted that the documentation for the MTN market is actually probably on the scale of 1 to 10 of difficulty. It probably sits at kind of at the 1, that meaning low, boilerplate, easy to do. I think generally people might say EMTN, Euro Medium Term Note Program, sits somewhere around about 5, and maybe 144A sits kind of at the 9 or 10 because it's a bit more complicated, the process. So you can set one of these programs up for around about, it's probably 50, 60,000, depends whether you're secured or unsecured, but relatively low cost. And these are programs that simply sit on the shelf, they're evergreen, and we typically suggest people don't put a lot of detail in the document around the corporate profile to avoid having to update it so you can incorporate by reference. So you have a very brief IM. The IM really is more about the terms and conditions. It's not so much about the corporate profile. It's not about the key risks and so forth, and it's a world away from a prospectus. There are a deep dealer agreement, deep poll, and registry services agreement. That's largely it. It also has very, very simple, and it kind of is. And then from an issue-specific purpose basis, you have a pricing supplement. So we work off a term sheet, you have a pricing supplement, subscription agreement, and logical documents. So again, very, very kind of, one of the speakers at the last FTA panel up in Brisbane was saying he couldn't believe how easy it was to access the market. So I think that's one of the many attractions of the local market. How am I going for time, David?
About 2 minutes.
2 minutes? Okay. So I'll conclude. My last slide really is about going back to the outlook, themes for 2014, and I'll whip through these quickly. So in general, we actually see a very modest supply outlook for 2014. There's a lot of issuance done in the last quarter of last year, particularly in the syndicated loan market. 50 billion in syndicated loans in Q4. Already Q1 is actually looking about half of the prior comparable period. So in general, though, we actually are seeing a very modest outlook for supply across corporate bond space, across debt markets generally. We're seeing a continued shift towards tenor, which I mentioned is being driven by investors' desire for yield and a comfortableness to move further out the curve. We expect to see continued offshore interest to bid for Australian bonds. I mentioned we're working, so I'll come back to that point in a second. So yeah, continued offshore bid for bonds, which is very, very, very strong trend, and we think it's a structural trend. Strong investor demand for triple B and yield, goes without saying. We do continue to see international corporates look at this market, and because particularly around that 5 to 7 year mark, when you swap back into LIBOR or even just comparing levels, this market can price on par with the US market and be globally competitive. So no one ever issues here to be a good guy. They price because they can actually price at a level that's globally competitive. And certainly in that 5 to 7 year space we can say that. As I said, beyond their 10 years, not really our sweet spot necessarily, but we do see some pretty punchy transactions from time to time. Fonterra did a tremendous one recently. Continued trend in strong deal subscription. So, for example, mentioned that we launched a transaction for Perth Airport, a minimum of 150 million yesterday. Well, as of this morning, that order book was 640 million and growing. So, it's an example of typically, and that deal won't be that size, so it's typically an example of there's more demand than there is actually the available supply. And hence the market doesn't necessarily, when I say there's 12 billion for the market, it doesn't necessarily represent the sum of all the demand. The reality is the market could easily be twice that size. It's just a case of issuers actually really needing that amount of funds. And the final point I'll just make on this page, or the second last point, is so what makes it attractive is it to actually be an issuer? Why would you go to the corporate bond market? Well, it's funding diversification. You're getting 10 of the banks don't offer, but also the yields are actually very, very low now. And the final point before David pulls me off here, up to the stage, is that we're actually seeing more issuers looking to come to the market. So the poll we did at the FTA Congress last year suggested that if you have, did you expect to use capital markets more or less? Well, close to 92% are looking to actually come to the capital markets in some shape or form this year. So we're very, very positive about it. So overall, the market's very positive. We don't see a hell of a lot of supply coming through, but we think the market is sort of set for growth for the next few years, and we think this trend will continue. On that note, I'll finish.